Hello, how you doing? You're welcome to this call. Today we are going to be discussing imbalance, and as you can see to the upper left of my screen, we are going to be talking about what is an imbalance candle, how to spot an imbalance candle, and how to trade an imbalance candle in brackets where your entry is going to be, where your stop loss, take profits is going to be, right? So I want to know how you doing. I hope you're fine, right? And how's the training been so far? I hope you have been getting some a lot of values, right? Yes. So today, what is an imbalance? Do you have a prior knowledge as to what an imbalance is? If yes, maybe at the end of this call, what you think an imbalance might be different or could probably be the same. But then I'm thinking might be the same actually, because I think there's only one meaning to an imbalance. Although we have people call it different names, but I think the concept is still the same, right? Exactly. So what is an imbalance candle? That's the first thing we are going to be looking at on this call. And quickly, let's head over to Google and let's see what Google has for us. Okay, as regards the definition of what an imbalance is, before I will give you my own understanding as to what an imbalance is, right? So we'll come to Google and so I've searched for it already. What is an imbalance in Forex, right? You have to put in Forex to be so they can give us the proper definition, right? We can see here it says an imbalance in the Forex market can be defined again as an imbalance between buyers and sellers. Okay, then a bullish imbalance has more buyers behind it, and a bearish imbalance has more sellers behind it. All right, so let's come again. An imbalance in forex markets can be defined as an imbalance between buyers and sellers. Remember, this imbalance we're talking about is under institutional candle, right? That's the last two video. I believe when I was talking about institutional candle, I told you there are entry candles for me, right? And there are three entry candles I like to look out for in the market. First one being the mitigation candle, which I explained to you in video 16, right? This call is going to pop up now. Yes. Right. So today on this call now, this video 17, I'm going to be teaching you, explaining to you the other type of candle I like to look at for in order to get my trade ideas, right? Which is the imbalance candle. And as you can see now, it says here, an imbalance on the Forex market can be defined as, again, the imbalance between buyers and sellers. When you hear the word imbalance, that means it's not balanced. Right? Because the opposite of imbalance will be balanced. Right. So if a market is balanced, what does it mean? If a market is imbalanced, not balanced, what does it mean? Right. Now already you can see that it is caused as a result of the buyers and sellers not in agreement. Right. And then it goes ahead to say a bullish imbalance has more buyers behind it, and a bearish imbalance has more sellers behind it. So that gives us an idea that we actually have two types of imbalance, a buy imbalance and a sell imbalance. So already now you know that if you are going to be trading a buy imbalance, means you're going to be looking for buying opportunity based off that imbalance. And if you're going to be trading a sell imbalance, you're going to be looking for selling opportunity based on that sell imbalance. It's as simple as that. Now, if we come down here to say, how does, or to look out for this, to look at this, how does imbalance work in Forex, right? It says here, an imbalance of orders is when a market exchange receives too many of one kind of order, buy, sell, limits, and not enough of the other's counterpoint. For sellers to complete their trades, there must be buyers and vice versa. When the equation is slanted too heavily in one direction, it creates an imbalance. Okay, now you can see it, right? So imbalance is the that is caused as a result of, number one, buyers and sellers not in agreement. Number two, I will say it is caused as a result of heavy orders being placed in the market in one direction, right? So, for example, we have a lot of people buying, right? Or there is a big order that came in to push price to the upside. There's a big buy order that came in to push price all the way to the upside, right? Now, price is going to buy up. Now, it is not giving, remember, for a candle um to be complete, the candle should have five main properties, right? The open, the high, the low, the close, right? Now, I'm going to be showing you on the chart how a complete imbalance should look like. A balanced candle, brother. Now, if a candle is not balanced, what does it look like? And I'm telling you that imbalance is caused as a result of heavy orders being placed to the market in one direction, right? So I can come in and say, okay, Euro USD, I want to buy Euro USD. And now I'm using a very, very big order because I have a very, very big, like very, very big amount of money in my account, right? When I mean very big, enough to actually move price, right? That means I'm one of the institutions, right? So now I'm getting in with a very big order, and that can actually take price in one heavy direction. So if I'm buying, price could just pump all the way to the upside, right? And I think a very good example of this will be like it happens very, very well in the crypto space, right? Let's say, for example, um, a new coin just dropped now, and a lot of people are buying the coin, right? And then we have what we call the V6, right? The V6 simply means these are people that actually get the information a lot earlier, and then they act as that, like they buy a lot of the coin, majority of it, right, just to profit out of it. So once the coin goes up and the price of the coin has gotten to a particular level, then they sell it down, they take their profits. Now, when they start to withdraw their profit, like they start to close their trade on that particular coin, then we're going to definitely see the coin dump to the downside, right? So that could be, now that's heavy, because if you're buying in order to take profit out of the market, you're going to sell back your position, right? So if you're buying so you can sell back your position later. That's how you close your trade, right? So now, if this V6, the big players in this coin now have bought, and then the price of the coin rose to the upside, and then majority of them start to withdraw their their trade, start to close their trade, we're going to see a heavy dump in the coin. And that is too much of selling pressure happened. And then there was no room for buyers to come in. And then the coin created a very big bearish candle. Now, in the Forex market, it could be maybe a particular news is about to come out, right? Maybe we have FOMC, or we have let's say we have CPI, that's the consumer price index for dollar index. Now, if that news is about to drop, most of the times these institutions like to take advantage of this big news to move price in one direction. And then when the news is about to drop, or when the news drops, we see price move strongly in one direction. Price has created an imbalance. So now, what do you do when you see that imbalance? Remember, you are a technical trader, right? So now you're not depending on indicators in order for you to get in on trades. Right. So how then do you master the act of trading? How then do you master the act of getting entries? You need to understand the candles. I've been telling you that, right? You need to understand the candles and come into oneness with the candle. Like the candle is going to be giving you information, and you should be able to interpret that information. You should be able to interpret the information and be able to see if there's going to be a trade idea from what the candle is printing, right? Exactly. So this is an imbalance. What is an imbalance again? It is a constant struggle between buyers and sellers, right? But now, how is an imbalance created? An imbalance is created when there is too much of trade pressure in one direction. Now, if there's too much of buy orders, it's going to create an imbalance. if there's too much of sell pressure, is going to create an imbalance in the market. So now what does an imbalance look like? What does it look like? NASDAQ. Okay, yeah, had an alert on NASDAQ. It just popped. So now, how do you spot an imbalance in the market? So now I'm gonna show you this now. So let's say we do have this candle now. So we have this candle, all right, and then we can just change this the color of this to green, and then we have another candle. Yeah. Okay, let me say this one is a bearish candle now. Let's say this is a bearish candle. All right, and then we have this candle here. Okay, perfect. Okay, yeah. All right, this, let's say this brought all the way to the upside, and then we now have another candle to the upside here. Just something like this. Exactly. So now this is, we had how many candles here? We have 4 candles, 3 bullish candle, and 1 bearish candle. So now how do you, already from this, you can see that there's what? There's a lot of buying pressure here. Right, you can see because price is going to the upside. So now how is an imbalance created? How do you spot an imbalance? So let's just complete the candle formation by giving it some wicks. So now you can see that, like I said, there is buying pressure in this, from this candle you're seeing already, because now this has 3 very bullish candle and 1 bearish candle. So now in this place, there is an imbalance already. Just from this 4 candles now, I can see an imbalance. Remember what I said an imbalance is, right? Or what I said what an imbalance was. An imbalance is caused as a result of heavy orders being placed to the market in one direction, right? So now, if you look at this now, you can definitely see that there is more buying pressure than selling pressure already from just this 4 candlestick, right? So now, how is an imbalance created? As a result of what? Heavy orders being placed in one direction, right? So now, how do you spot an imbalance? The first thing you need to know is that an imbalance consists of 3 candles. Okay, that's it. Very important. Very, very important. An imbalance consists of 3 candles. So you cannot have a 1 candle that's going to give you the imbalance. An imbalance consists of 3 candles. So you need 3 candles in order for an imbalance to be formed. Okay, and the 3 candles, the first candle, they have first candle that starts the imbalance, second candle that creates the imbalance, and then the third candle that completes the imbalance. So you need, these are the 3 candles. Number 1, the first candle that starts the imbalance. Number 2, the second candle that creates the imbalance. And then number 3 is the third candle that completes the imbalance. Exactly. So now if you look at the charts now, if you look at this candle, we have 4 candles here. But now it says 3 candle is what creates an imbalance. So definitely one will not be needed out of these 4 candles. right? So now, how do you spot an imbalance? Now, looking at the candles, we have this first candle, we have the second candle, we have this third candle, and we have this fourth candle. What can you notice from this candle? I can see that in this area, from here all the way to here, there is no wick to the left and right of this candle. Are you seeing it? There is no wick to the left and right of this big candle. This is what we call an imbalance. Some people call it a different name. You can hear some people will say it is called fair value gap, right? Some will call it inefficient price action, some imbalance. So we have different names for it, but it all means the same, right? An imbalance. So now, if you are to spot an imbalance in the chart, this is how you're going to look for it. You look for the candle that does not have any wick to the left and to the right. Okay, look at this candle. The wick to the left stopped here. The wick to the right stopped here. So there is still a space in the body of the candle where there is no wick to the left and there is no wick to the right. That is an imbalance in the market. That is what we refer to as an imbalance in the market. So now what happens if this candle sold down to this area? Then definitely what that means is that the imbalance is from here to here. See it now? That's it. So imbalance is in a candle, how you can spot it when there is no wick to the left and when there is no wick to the right. That is how you spot an imbalance. And what this means is that there was a lot of buying pressure that even the next candle that opened, although sold down, but did not balance up the candle, because every candle should be balanced. And now, being out, when I say be balanced, what do I mean? Every candle should have a wick to the left and a wick to the right. So the candle that starts the imbalance, which is the candle one, as you can see, is this area here. This is candle one. Candle that starts the imbalance, which is this one here. This is the candle that starts the imbalance. Number two, this is the candle that creates the imbalance. It's the second candle is the candle that creates the imbalance. And then the third candle is the candle that completes the imbalance. Exactly. So you see it now? This is a complete imbalance. So an imbalance consists of three candles. So if you have two candles, the imbalance is not complete yet. We need a third one to create. Now, why do we need a third candle? Because we need to know, okay, this first candle created the high up here and then closed here. The second candle bought all the way up. Okay, we're beginning to see the imbalance, right? But now we need a third candle to at least come create the low. So how far down is it going to go? Is it going to completely fill the imbalance? If you completely fill the imbalance, in this case, let's say we have something like this, then there is no imbalance on this trade. And this candle, there is no imbalance here because there is no gap. There is no, there is no area in that candle where there is no wick to the left and there is no wick to the right. In this candle now, this candle is completely balanced because there is no area where we can find no wicks to the left and no wick to the right. You see it now, but if we have something like this now, this is an imbalance because it creates the third candle sold down, but then did not completely fill the imbalance, and then price rejected from there, and then price went up. It didn't complete the imbalance, it just sold down to an extent and then rejected and then went up. So that remaining um area where there is no candle to the left and right is what we refer to as an imbalance. And you will be amazed as to how price usually comes back to this area and then give us a play to the upside if you're looking to buy. We've seen this happen so many times that it is very, very important that even though you have other, like people who do have other trading strategies, but I've seen people that still make sure that they are using imbalance as an area of entry, because this concept goes as far back as when the Forex market even started. Like I've done it with the team. Like we've actually done a back test, and we went as far as 1960, 1970, and we were seeing how these imbalances were playing out. That shows you that even way before people start to know about what it is, it was already there. Because the market needs to be balanced. So if the market creates this imbalance, it's going to come back into that area to give us a candle and then play off it. So what am I trying to say? Now, we can continue to have, I'm just going to be fast with it again. Uh, this is what's going to happen. Okay, I'm going to do this. We're going to have something like this. Okay, and then we have something like this. This is another bullish candle. And then price creates a bearish candle. And then this bearish candle sold down. Comes into the imbalance and then gives rejected, right? And then give us the next candle, a bullish candle. And then we have something like this. You will see this happen so many times in the market. You've seen it? Exactly. Right. Price will create the imbalance and price will come back into the imbalance. Are you seeing how this candle sold down now into the imbalance? And then what happened? Rejected. And then the next candle printed, and then prices going to the upside. This is how to play an imbalance. First, this is how you spot an imbalance. An imbalance is created as a result of what heavy order has been placed to the market in one direction. An imbalance consists of three candles: the candle that starts the imbalance, the candle that creates the imbalance, and the candle that completes the imbalance. Now, what happens after you spot that? Because the market is still bullish. Now, how can I enter this trade? How do I get in on this trade? In order to continue taking price to the upside, I'm going to be looking for what? An imbalance. So if I spot an imbalance below the opening, below the market price, that's going to be my entry. So I'm just going to enter the trade, wait. I'm going to have my limit order waiting at the imbalance because I know price will come back to that imbalance and then give me a play of it. Now, it is not in every case, it is not in every scenario that price comes back to the imbalance immediately like this. There are cases where price would take time, really go far before coming back into the imbalance. But the idea is that the market has created an imbalance. It needs to come back to balance it. That's the idea. So now how do you trade the imbalance now? Once you've spotted it and it is in line with structure, remember the checklist, trend. You want to know the market trend. If the price is going higher, if the market is bullish, then you want to be looking for what bullish imbalances to play, which is an example of this one. This is a bullish imbalance because you're looking to buy this. So an example for a bearish imbalance would just be the opposite, where you'll be seeing a red candle, right? Exactly. So now you spot the imbalance, the market trend, first thing, right? The market going up, and then the next thing is what your range. because it is within your range, you are going to get the imbalance you want to play. That's why the range is very, very important, right? Now, after your range is the fib. I know I have not taught you fib yet, but I'm going to teach you after this, the next trade entry candle, which is the institutional smart money cube candle. Then I'm going to be talking about the fib. But according to the checklist is the trend, the range, and then the fib. What the fib does is that it's going to help you to know if you're buying at the discount area or if you're selling at the premium area. Now, when you've been able to see that, okay, you're buying at, you are looking for, you want to buy at a discount area. Now you have your range, you have your fib. Now you're going to be looking for what buying opportunities at discount. And when I say buying opportunities, you're going to be looking for what any of the three institutional candle in order for you to get your trade. Either you're looking at the mitigation candle, or you're looking at the imbalance candle, or you're looking at the institutional cube, smart money cube candle. So these are the three things I like to look out for inside the range, at discount, or at premium areas when I want to buy or sell. So now, how do you trade an imbalance candle? How do you trade it? It's very easy to trade. Already you know where your entry will be. Your entry would be inside the imbalance. Now, there are three entries when it comes to trading an imbalance. You can't take three entries when it comes, like there are three entry techniques to trading the imbalance. Okay, there are three techniques to trading the imbalance. Number one, entry at the open of the imbalance. Okay, number two, entry at the 50% of the imbalance. And then the third one, which you know already, entry at the close of the imbalance. That is how you can trade it. You could put your entry in three places. Number one, either at the open of the imbalance, or the 50% of the imbalance, or at the close of the imbalance. Now, what do I mean by entry, 50%, and close? Right, you can see when this price is coming down, as soon as it touches this area here, that is the open of the imbalance. So this area in this place, yeah, this is the open of the imbalance. Exactly. This is the open of the imbalance here. Now, already 50% means it's going to be half of the imbalance. How do you get 50%? You just take out your fib, and then you just measure from this close here, and then take it all the way to the high, the open there, and then you can just 50%, just divide it. So this area here, this is the 50%. That is half of the imbalance. Your entry could also be there. This is 50% of the imbalance. Okay, and then the third entry you could play is the close of the imbalance. Exactly. So any of these three you can use as the entry technique. You could either decide to play the open of the imbalance, you can decide to play the 50% of the imbalance, or the entire close of the imbalance. The idea is the same, right? It's just there are times price can tap the open of the imbalance and then reject. At times price will come to 50%. At times price will come to get to the entire close of the imbalance, like fill it up completely and then reject from there. Like in this case, now you can see this candle did not fill it up completely. We still have this little one here. If you look at this now, we still have from year to year. This is another little imbalance left, right? So it is not compulsory for price to fill it up completely. Okay, it could just come inside. The idea is that price comes back to balance price and then reject off from there. So there's like a pause in the buying momentum because the market wants to come and balance the imbalance it's created, and then it is going to continue buying. That's the idea, right? That price is actually bullish, but okay, it is more like the institutions are saying, oh, we forgot to fill up this imbalance. We forgot to balance the market. Let's quickly do that and continue buying up, right? So just think of it like that. So when you think of it like that, that institutions are like, okay, let's quickly come back and balance price and then go back, continue our buying momentum. That's an entry for us, right? Because now they're coming back to do something and then they're just going back in that same direction. So I can set my limit and wait for price at that area. And price comes there, fill up the imbalance, activate me, and then go to the upside. That's it. So now this is an entry. This is how to get your entry. This is how to place your entry in the market. So now where is your stop loss going to be? Now, the stop loss rule for trading the imbalance is that the stop loss should go directly below the low of the first candle that starts the imbalance. That's it. This is the stop loss rule for trading the imbalance. Exactly. The stop loss rule for trading the imbalance. Coming. Let me make this directly. Okay, yes, and then we can make that big. Exactly. So now the stop loss rule for trading the imbalance is that the stop loss should go directly below the first candle that starts the imbalance. So now, where is the first candle that starts the imbalance? This is it. This is the candle that starts the imbalance. What this is saying is that your stop loss is going to be here. That's it. So stop loss is going to be here. Stop loss. Exactly. This is it. This is where your stop loss is going to be. So if you're getting in here, stop loss should be at this down area here. And now where should your TP be? Remember, I've taught you risk management. I told you you should always use a 3-to-1 risk to reward, right? A 3-to-1 reward to risk rather. Right. So now if your stop loss is here, and let's say you decide to play 50% of this move, now, whatever the stop loss is from your entry to the stop loss, okay, whatever the peep is, let's say maybe 30 pips, your TP is going to be 3 times that. Okay, so there's no need for you to be looking for, okay, where should I put my TP? Okay, where should I? 3-to-1. If you're risking 30 pips, your TP1 is 90 pips. If you're risking 20 pips, your TP1 is 60 pips. So for the first TP, it should be 3-to-1 reward. Okay, so now let's do, okay, and then let's make this green because now we're talking about take profit. And then I can say, let's remove all of this. Okay, so now the take profit rule for trading. Oh, so I'm supposed to take profit rule for trading the imbalance is remains, yes, first remains the same. Okay, that's it. The take profit remains the same, which is reward of 3 to risk of 1. That's it. So whatever you're risking, you want to make 3 times more than that. Then the second take profit can't be at an imbalance above. That's it. So your first TP definitely should be at what? 1 to 3. And now if you want to go beyond 1 to 3, maybe you want to, the price still looks like it wants to go up. Now, where can you look to take second profit? Look for imbalances that is above if you're buying. Okay, above in bullish conditions and below in bearish conditions. Exactly. That's it. So the stop loss, let's start again from the stop loss. The stop loss rule for trading imbalance is that the stop loss should go directly below the low of the first candle that starts the imbalance. Okay, that starts the imbalance in a bullish condition and directly above the first candle that starts the imbalance in a bearish condition. So we have bullish and then we have bearish. Balance now. Okay, exactly. So for the stop loss, if this is a buying, this is a bullish condition, as you can see, the entry anywhere either the open 50 or the complete fill, stop loss should go at the low. That's the candle that starts the imbalance. If it is in a sell condition, the stop loss will go directly above the first candle that starts the imbalance, right? Because the idea is that price should come back and fill the imbalance. So price should not really have any business coming all the way down to this area. That's it. Okay. And then for the take profit rule for trading the imbalance first remains the same. It is the same thing, 3 to 1. Whatever you're risking, you want to make 3 times that. So you don't need to have a reason as to why your TP1 should be at a particular area. Whatever, anywhere it is, that's where it is. That's where 3 to 1 is. You place it. Okay. It has nothing to do with what kind of candle it is. No. Whatever you're risking, you're making 3 times that. Then your second TP, that is you want to hold more. You believe price is still going to go up. Now you can't look to take price. Okay, maybe you've done your analysis and there's another imbalance up, up, up that you feel price might get to. Then you could put your next TP at that area and wait for price to get there and you take a second profit. I mean, I did it for NASDAQ and I had about, gave me 1 to 19 weeks to reward. So it was really amazing. And then the advantage of that is that it helps you to increase your weeks to reward ratio. So now this is how to trade an imbalance. I've explained to you what an imbalance is. I've given you where the entry should be. There are 3 entry areas. You choose the one that's, there is no one specific one. All right. So don't ask me which one should I play. Okay, it is, you can decide. Today you can decide to play open, tomorrow you can decide to play 50 level, 50 or close. But what I would say is that there is what I call bank numbers. Okay, so there's not going to be a topic for that. Okay, but then I'm going to say it on this call. There is something I use that I call bank numbers, and I learned it again from my mentors, right? We have these institutional numbers that I always make sure I add to my trades. And the institutional numbers are numbers ending with 00, 20, 50, 80. Okay, so anytime I'm getting in on a trade, I'm making sure that my entry is ending at either 00 or 20 or 50 or 80. That's it. So if I want to play this imbalance now, I'm going to be looking for which area, and inside this imbalance, can I get 00, 20, 50 or 80? That's it. If I get 50 inside and I also get 00 inside, I just have to pick one, right? That's it. The idea is that price comes into the imbalance and price rejects. So that's how I play the entry. I always make sure that my entries are ending with these bank numbers. Okay. And then your take profit, I've already said it. First TP1, 1 to 3, and then external profits. So now let us go to examples and let me show you some examples on the chart. So let me just take a quick screenshot of this. Okay. Now let us look at some examples on the chart. First example I want to show you is this. Now, this Euro USD, we've actually been, this buy, you can see this consecutive buy that happened for how many days? 1, 2, 3, 4, 5, 6, 7, 8, 9, 9 days of straight buys, right? So first we wanted price to take out this liquidity that was here. That was why we were looking to buy this. So we had a daily liquidity in this area to the upside. And then I could see how price came all the way to the upside and then was coming down. Now, if you look at this area, okay, looking at this area now, can you see the imbalance? Can you see the imbalance? Definitely, I can see it. This is the imbalance from here to here. Let me zoom in so you can actually see it. So let's go now. An imbalance consists of how many candles? 3 candles. Now let's do. This is number 1. This is the candle that starts the imbalance. That is candle 1. Number 2 is the candle that creates the imbalance. Number 3 is the candle that completes the imbalance. Now, do we have an imbalance now? Definitely. So now where's the imbalance? From this high to this low here. This week stopped here, this week stopped here. Now you can see that there is this big candle. There is no wick to the left and there is no wick to the right. Exactly as at now, looking at just this 3 candle, let me use the replay tool and take all of this away. Exactly. You can see this is the imbalance, right? There is no candle to the left and there is no candle to the right. Now, this is a bullish market. Now, you can see how price is buying to the upside. Price created an imbalance. Structure is going to the upside. Now, are there reasons why we see price? Are there reasons why we feel price is going to continue buying? Definitely why, because I can see this liquidity to the upside here. So I have a target, I have a future target as to why I'm looking to take price to the upside. Okay, so I'm establishing what a bias now. From what I'm seeing, it looks like Euro USD is going to take out this liquidity that is up here. I've taught you liquidity already, but liquidity to the upside here. So definitely, I'm going to be looking for higher pricing to take price up, so price can capture this liquidity. I can join the institutions to take price to capturing this liquidity. Now, where is going to be my entry? Remember, 3 entries. There are 3 entry techniques. I've taught you the first one, mitigation candle. Second one, imbalance. Right, imbalance. And if you look at imbalance, it's something that keeps happening over and over and over and over again. Look at in this area here, from this area here to this area here, there was an imbalance. Can you see how price came into the imbalance? And then what happened? Boom, spent quite a number of days, rejected all the way to the upside. Price was selling down in this area, created this little imbalance here, very small imbalance from this area to this area here. See that small from this area to this small imbalance? Then can you see how price came back into the area and then rejected to the downside? That is its imbalance. You will see it play out a lot in the market. It's just that in order for you to get the right imbalance to play, so you are not caught up with the multitude of imbalance the market presents every single time, make sure you are aligning yourself with the checklist. Make sure you have a bias as to why you want to take that imbalance trade. For this now, I'm seeing what the liquidity to the upside. So there is equal highs here. There is money sitting in this area, and I feel the institutions are going to take it out. So I see this imbalance. I believe that the institutions will come into this imbalance and then give me a play to the upside. So this is the imbalance now. Remember, your entry can either be at the open 50% or close of the imbalance. Let's say we want to take the entry at the 50% of the imbalance. Stop loss is going to go where the candle that creates the imbalance, which is going to be down here. And our TP is going to be 3 times what we are risking. So it's just going to be TP is going to be up in this area, which is going to be 3. Once it says 3 here, that means we're risking, whatever we're risking, we're going to make 3 times more. And this is it. I have my trade idea already. And then I'm just going to wait for it to have play out. And look at what happened. You see, price came into the imbalance, spent a lot of days in the imbalance. You can see, price came down, went up, came down into the imbalance. First, look at what happened in this area. When price sold down here, it filled this imbalance, but did not fill it up completely, right? It left this one here, from this area to this area. Now it came back down, completely filled it, went up, came back down again, and then look at what happened. We had to remove the replay button, and then this happened. And you see, boom. Now, did this trade buy up or not? It did buy up. Equal highs, liquidity has been captured. If you do it to the front now, you can see on this day, this big candle swept the liquidity that was here, and then price came all the way to 1 to 3, and then price rejected to the downside. This is one example of an imbalance. But now this stop loss is very big. This is about a 118 pip stop loss. And it is big because you're trading it from the daily time frame. Just like I've showed you now on the daily time frame, it can happen on even the 1 hour time frame, whatever time. And I like to play imbalance a lot. Now, this is one example on Euro USD on the daily time frame. Now, let me show you a trade I took on NASDAQ with imbalance. Very, very amazing trade. I'm going to show you. Let's come to the indices, come to the US indices, and come to NASDAQ. Right now on NASDAQ, I'm just going to go down to the 1 hour. Okay, first look at this on the daily. The NASDAQ buy I took that lasted for 12 days was based off an imbalance. Are you not even surprised? Look at this now. This is an imbalance here, right? Can you see? Candle that starts the imbalance, candle that creates the imbalance, candle that completes the imbalance. Immediately I saw it, we didn't even see it immediately. It was somebody that called out this trade for us on a live call and was like, Coach, please look at this imbalance on NASDAQ. Do you feel price is going to reject from there? And immediately I saw it. I knew that this was a play already. But I didn't take this trade based off the daily time frame, because if I was going to take this trade on the daily, it means my entry will be here. My stop loss will have to go way down here. Can you see? Way down here. And then my TP 1 to 3 will be 1 to 3 will be here. You see, that means my 1 to 3 will be up here. So I would have to wait for, how many days? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. 14 days before I can even make 3 times what I'm risking on this trade. Because the stop loss is big. The bigger the stop loss, the more time it's going to take for you to get to 1 to 3. So if I'd entered this trade based off the daily time frame, this would have been a 14-day trade for me. But now, and it would have just given me 3 times what I'm risking. But because I have an understanding of how the market works, remember, now this trade, we were buying this trade because we wanted to take out the liquidity. There was an equal high in this area. You see this liquidity from this area here to this area here created the liquidity. So we were like, oh boy, this is amazing, right? We saw the liquidity, and then I was like, okay, now let's look to buy NASDAQ from this imbalance. Look at how precise this was. Price came into the imbalance and then rejected to the upside. Now my entry was not based off the daily, going down to the 1 hour. That was where I had my entry. Okay, that was where my entry was. So on the 1 hour time frame, look at this. Amazing, amazing entry. Now I was waiting for what break of structure. Price came into my point of this area here is from the daily area I'm expecting price to reject from. But I do not want to take this trade because the stop loss is going to be really big if I'm taking it on the daily. So what I did was to wait for what a lower time frame entry, which I'm going to be teaching you in phase 3. Now, the first thing I did was, okay, price came into that point of interest where I'm looking to buy. I'm going to wait for price to give me a bullish structure, a market structure shift. So price was coming down, gave me this low, lower high, and lower low. And then I saw that price broke this structure to the upside here. And you see, we had a break of structure in this area. So now price has broken structure to the upside. I have this now as my higher high. Yeah, and I have this as my top range rather. Yeah, this was my top range. And I had this area down here as my down range. See, so now I have a range. So now I'm looking for buying opportunity in that area. And then I saw what, just like the daily time frame, I also saw it on the 1 hour. This was an imbalance here. From this area here to this area here was an imbalance. And I knew, because I know how to trade the imbalance, that price was going to come back down. Look at the entry. Look at this. Are you seeing 19? This was a 1 to 19 risk to reward. So you just imagine risking $100 on this trade. This has given you $1,900 profit. Is that not insane? Oh my God. See, I knew that price was going to come into the imbalance. Now, I told you that what if you're going to play the imbalance, your entry, and if I'm to show you my entry, just look at my entry. See, I was playing what? 147.25.0. That's ending with what? 50. That's a 50 level. As a matter of fact, let me show you that I actually took this trade before I play out. Okay, just I'm coming. Which day was this? June 27th, around June 27th. So I'm coming. Let me quickly look for the markup. Let me manually type it. All right, let me manually type it. So we have tradingview.com, and we have the /x/4. We have JHL0UTS/. I hope I'm correct with this. Oh, definitely. Yes, exactly. So you see, this is it. Look at the dates up here to the upper left of the screen. June 27, 2023, 1:36 p.m. That was when I had this marked out. You can see June 27. So this is not me using the replay tool just to cut it. I actually saw it before it happened. And look at, this was the candle that I was printing, this bearish candle I was printing. This is actually 1 p.m. candle going to 2 p.m. All right, let's confirm. This candle coming down. Can you see? Look at the time down. June 27, 13 o'clock. That is 13 about to create 1 hour candle. So I saw it before it played out, and I entered this trade, and can see I held this trade until it got to my final TP at this high. So yes, all of this price action I was in on the trade lasted for 12 amazing days. That's it. And then also in between price even getting to the TP, I had some other entries in this area. You can see this area based off what the imbalance entry was there, 1 to 3. Another entry here you can see based off this imbalance that was there. And then this other one was based off a 30-minute imbalance also. And then I took price all the way to the upside. Exactly. Look at it. Can you see the entry was also based off this imbalance that was here. So are you seeing now? Exactly. So that is how to play an imbalance. Definitely. So that is going to be it for this call. If you do have any question, please feel free to um, drop your question in the question group. When I see it, I'm going to attend to it. All right. So I hope you enjoyed this call. Do have an amazing day. Bye bye.